The secrets to a company's success can be found in its financial statements. If you want to invest or if you are a business owner, you must learn how to unlock them.
Financial statements can be overwhelming and it's hard to know where to focus. So how can you consistently analyze them in a few minutes to understand a company's performance? Well, we are here to help you.
In this video, we're going to share with you how to read an income statement to understand a company's performance. And we'll go through specific examples to help you visualize it. My name is Bertrand Seguin, and I'm the founder of App Economy Insights.
And I'm Stephanie Wong, tech industry veteran, engineer, and creator. There are three primary financial statements that every business owner or investor should know. The income statement shows a company's profit or loss over a period, or P&L for short. The balance sheet shows what a company owns and owes at a specific point in time. The cash flow statement shows the cash inflows and outflows over a period.
So these three documents are like the holy trinity of finance, and understanding them is crucial to making informed decisions about a company.
We'll have other videos breaking down each financial statement and explaining what they're all about. First up today, we'll talk about the income statement. This document shows a company's financial performance over a specific period, usually a year or a quarter.
So the P&L shows you three things: how much money the company has made, how much it spent, and how much it kept as profit.
So let's go over what's included in a P&L. Revenue. Think of revenue as money coming in the door. Expenses. Think of expenses as money going out the door. Net profit or loss. The company's profits are calculated by subtracting expenses from revenue. This is the money left over after everything else has been paid for.
As an example, let's use the largest company in the world, Apple, using their performance of the 12 months ending September 2022, which was their fiscal year 2022.
If you go to a company's investors relations website, you'll find its financial statements. The P&L will look something like this.
Well, I love using visuals to help us digest financial statements. So let's put these numbers into a diagram. In gray here, you can see the revenue. So it's the money earned from selling products. For Apple, it's iPhones, MacBooks, iPad, watches, or AirPods. But we also have services. Those are the digital subscriptions, App Store revenue, transaction fees, and much more. And then in red, you can see the cost incurred to generate its revenue. We'll cover them in detail in a second. And finally, in green, you can see basically whatever is left after deducting the expenses. Not all P&Ls look the same. Some provide more detail and some provide less. In addition, some industries reported numbers differently, such as banks or insurance companies. Apple's P&Ls is the most common format.
Here is the structure of a standard P&L. Because of how a P&L is structured, analysts often refer to revenue as the top line, net income as the bottom line. It's based on where they appear in the income statement.
So before we tackle them one by one, if you like this video, remember to like and comment down below. This will help us be discovered, for us to bring more educational content to you for free.
All right, revenue includes sales of goods, like physical products to a customer, such as iPhones for Apple or coffee for Starbucks, sales of services, digital subscriptions like Apple TV Plus, consulting or repair work, royalties for allowing someone else to use a patent or trademark.
If we turn to expenses, they include everything from employee salaries to your rent. Cost of goods are the direct variable cost of producing a product or providing a service. For an iPhone, COGS might include raw materials, labor cost, or delivery costs. Then we have operating expenses. These are the indirect costs associated with a company's day-to-day business activities, such as salaries, rent, utilities, and supplies. They include sales and marketing expenses, research and development, or general and administrative expenses.
Finally, we have the net profit or loss. It's the amount of money left over after all of its expenses have been subtracted from its revenue. So in other words, it's a profit that a company makes. But keep in mind, it can be a net loss when expenses exceed revenue.
Well, there you have it. The income statement has a trove of information about a business, but it cannot be analyzed without proper context.
You have just learned the three key parts of a P&L. So next, we're going to be analyzing the P&L with the key ratios you need to know to appreciate how well a business is doing in just a few minutes. Our next video will give you the keys to analyzing a P&L like a pro.
See you right there.